talk us through the outlook. You've mentioned outperformance in your occupancy rate here in Hong Kong, but sales in the mainland has underperformed. How is it looking for the rest of the year?
So I think in terms of Hongkong Land, obviously we've got two parts to our business. We've got our prime properties investment portfolio, which includes the 4.6 million square feet of the central portfolio, 12 interconnected buildings in Hong Kong. We've got 4.5 million square feet of prime office space in Singapore in the Marina Bay district. And we're in the midst of building a huge project in Shanghai, West Bund, 18 million square feet. So these three portfolios really anchor our prime properties business. And as you mentioned, in Hong Kong, we've got market-leading vacancy statistics, which, despite the challenges in the market for the last 5 years, we've been able to maintain. So I think what we've seen in the first half of this year is clearly a huge upswing in capital markets activity. And I think that, combined with, the rents being at a cyclical low now, when you put those two factors together, it feels like there's starting to be some more positive momentum. Inquiries for office space also improved in the period, and rents in the second quarter stabilized. So I think from what we're seeing overall, this could potentially be a turning point in the Hong Kong market for prime office space.
In terms of those inquiries, why are those people interested now? I know we're seeing a pickup in IPO activity here in Hong Kong, but then there's also a lot going on outside, the geopolitics. I mean, just this morning we were listening in on President Trump speaking from Air Force One. We were asked, well, the media was asking him about whether or not the trade truce with China that would be extended, and he's going to be talking to his Secretary Bessent in the White House when they all get back to the U.S. to kind of hammer it out, and then he'll decide. But how has geopolitics and the trade war impacted your business?
I think there's two things to say here. I think on the first side of things, clearly it's created uncertainty in the market, and we've all been feeling that. And so for many of our occupiers, they're maybe being a bit more cautious around their investment plans. They're maybe being a bit more prudent around their office space needs. But I think on the flip side, given the uncertainties coming out of the US, I think a lot of investors have started to re-look at Asia as a market for growth opportunities, and in particular Greater China. So I think, from Hongkong Land's point of view, we've seen a lot more interest from investors in our stock, in our business, and actually they see a lot of value potentially coming through. So I think for us, it's sort of two sides of the coin.
Interest in your stock, and that makes me ask you, would you guys consider a listing here in Hong Kong?
We're obviously listed in Singapore. We also have a listing in London. That's done us very well for a long period of time. I think what we've seen in recent times, particularly this year, around Stock Connect and southbound flows coming through, there's clearly been a huge uptick in that. And I think it's something that we continue to monitor. I mean, it's not just the stock market overall, though. I think it's also the regulatory environment. And I'd like to see more of that develop in a positive way. And maybe if we see some regulatory changes combined with strong flows, then who knows?
Give us your take on what's happening with the mainland property market. That's a sector that we continue to closely watch, given the troubles with many of the property developers there. Build-to-sell contributions on the mainland. Talk us through the sales momentum that you're seeing and the expectations.
So as part of our strategic pivot last year, we decided and announced that we will no longer invest in the build-to-sell business. So for us, we're now gradually winding that down over time. We're honouring all our commitments, we're building out our projects, and we're handing those over to end users. Our portfolio in China, we're in 7 cities, mainly Tier 1, Tier 2 cities, and I think the market has been more challenged in recent times, but we are starting to move through our inventory. And in the first half of this year, we actually reduced our inventory by $0.3 billion. So despite the broader challenges, we are managing to work through that.
Back to Hong Kong here, and I know there's going to be 3 million square feet of oversupply in the CBD. That's according to the CBRE. In terms of vacancy rates, you guys are outperforming other developers, other agencies. But what is the outlook in terms of so much supply going into the market? How do you guys manage that?
So I think we've spoken before about the flight to quality trends that we've been seeing in Hong Kong, which are identical to what we're seeing in markets like New York and London. And what I mean by this is that, occupiers are looking for best-in-class office space. That's not just a specification of the building, it's also connectivity, the services, the amenities that are all around that. And at Hongkong Land, we've been investing in our portfolio for decades to ensure that it remains best in class overall. So what we're seeing is a lot of tenants deciding to take advantage of the lower rent environment and upgrade. And so really that's really what's been underpinning our low vacancy numbers overall. So whilst the city has a lot of supply of office in core central, there's actually quite limited supply. There's no new land becoming available. A couple of new buildings that have recently opened and one under construction, but they're actually heavily committed. So I think, for the best in class buildings in central Hong Kong, I think we're actually in quite a good position overall.